In one of the largest declines since the pandemic, the U.S. unexpectedly cut 92,000 jobs in February. Our next guest says the number delivers is a blow, the view of a stabilizing labor market, and the Fed will be a deer in headlights for the next announcement. Let's go to Olu Sonola, U.S. Head of Economic Research at Fitch Ratings. Thanks for joining us today.
Thanks for having me.
You've called this report a knockdown blow. Why?
Yeah, I didn't want to use the word knockout because it's still very feasible that we may get some sort of recovery over the next couple of days. But it was clearly a knockdown in that, there were signs of stability. Last month, we had really, really good job growth. You also saw that the unemployment rate ticked down from about 4.5% to about 4.3%. So just saying a tick up in the unemployment rate, a tick down in the participation rate, very, very terrible job growth numbers, actually job losses. And you're like, okay, here we go again. So clearly a knockdown. We could still get back up, but it just makes you think, this labor market is weak. And you still have to pay attention to it.
Okay, tell me when you look at the sectors that lost jobs. I know healthcare was a big one. What you get from that? I mean, healthcare was a big one, but we know there was also a strike of healthcare workers in 2 states. Does that make you less worried about that number?
To some degree, yes. I do think you just mentioned healthcare. There was a strike. Also, the weather too probably played a role with construction jobs and also leisure and hospitality jobs. And if you take those out, you're probably still thinking flat growth overall. If you also take a 3-month average, it's basically 0 job growth. So that is where we are. It's not quite bad because we're not hemorrhaging jobs significantly, but clearly low hire is no longer low hire. It's kind of like no hire. And fortunately, companies are not firing. So we're in some sort of equilibrium.
What is a hemorrhaging number for you?
I would say if you start to see 100K decline on a consistent basis, that will be hemorrhaging. That almost gets to you thinking, okay, what are we going to call this? You can't say we're in a recession of any sort because you're still seeing pretty good growth from an economic standpoint. But if we start to consistently see negative numbers, that's 6 figures, that's a problem.
Okay. Does this number, and you said an average of basically no growth for the last 3 months, does this change the deliberations for the Fed, do you think?
I think so, because, I was actually, I'll put my hand up and admit that I was thinking, okay, with some sort of stability, the Fed will be able to focus a little bit more on inflation, given that it's been about 3%. But clearly now, they probably won't know where to turn. The data is very choppy. The data is very noisy. And you're thinking, okay, I'm going to have to wait. I'm going to have to be cautious. I have to wait to see how this pans out. So certainly March is completely out of the question. Right after that, you have June. That's really when the Fed chair, all things being equal, should be in his seat. Will they cut rates at that point? Probably not. So you now have to keep pushing it forward. And you're thinking, even if they're going to cut rates, it may be towards the second half of the year.
Okay, so let's talk about or add in spiking oil prices, spiking gas prices as a result. To that picture of employment weakening, what kind of impact do you see both of those having on the U.S. economy?
The primary transmission channel is inflation. I mean, certainly inflationary, headline inflation will inch higher just a little bit. Clearly, the Fed prefers to focus on core. They tend to ignore the volatility on the food and the energy side. So the first port of call, I would say, is inflation. Second, I would say sentiments in general. Gas prices, you see those as you drive everywhere. It doesn't help consumer sentiment. And to some degree, the volatility, the geopolitical situation in the Middle East also does not really help business investment. And finally, you now have to also think about the impact on the markets. Markets have been quite volatile. U.S. a lot less compared to many emerging markets. That matters, right? If you start to see a lot of volatility in the U.S. and you're starting to see downturn in the markets and it creates that fear, then consumers could pull back and you could see that dent on growth.
Okay, Olu, I've got to leave it there. I'm out of time. But Olu Sonola is U.S. Head of Economic Research, Fitch Ratings. Have a good weekend. Thanks for your time.
You too.